Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, welcome back to YouTube and welcome back to a video on Bitcoin. So, first things first, I'm a bit under the weather at the minute. I'm deteriorating quickly. I think I'm coming down with the flu. My daughter's been at home for the last couple of days off school and she's been sick as a parrot. And I'm starting to feel pretty rough myself. So if I'm coughing, spluttering, clearing my throat, making a whole bunch of wheezing, squeezing and unpleasant noises that you have to suffer through this video, my apologies in advance. You're just going to have to put up with it because I don't think I'm going to be able to get this video out unless I do it today. So, anyway, I want to start this video by making a couple of statements. So statement number one, probabilities point to us being in a bear market. That's it. Now that statement is going to come with a whole series of assumptions that people are going to turn into a narrative, and it's going to be supported by a whole series of news articles and media narratives and broader stories and macro analysis. But I'm talking from a technical analysis point of view here. We're talking about technical analysis. From that point of view, there's a high probability we are now in a bear market. Now all the assumptions that come with that, the depth of it, it's going to be a year long, it's going to go 50, 60, 70, 80% drawdown, it's going to be a sharp correction. I would like, if you could for the moment, before we work our way through all of the analysis in the video, if you could just suspend those assumptions and not force them onto the chart and not force them onto the asset before we see them. So, probabilities point to being in a bear market. Can you suspend your assumptions for a moment? Second statement is it might genuinely be different this time. Now, that is not something anybody wants to hear, and anybody who uses that is often in a state of denial. Let me add a little bit of extra nuance to that statement so you understand where I'm coming from. If the first statement is true and we are in a bear market and all of the assumptions that we shouldn't immediately be making do turn out to be true, and it's a 50, 60, 70, 80% drawdown and it's a year long, bring it on. Let's go. I will buy Bitcoin at a massive discount. I love that to happen. Right? So the second statement of it might genuinely be different this time is not me sticking my head in the sand hoping that doesn't happen, because I would welcome it. It is a genuine possibility based on the Elliott wave segment analysis that we'll be looking at later about the seeming 5 wave structure into the high, but actually turned out to be 1, 2, 3, 4, 5, 6, 7 when we count them as individual waves. Anyone who knows Elliott wave will know the possibilities of what this means, right? And a lot of people in their broader analysis are going to miss it if they don't have that nuanced understanding. Okay, and that's the bit which is going to help put all of this into context. So please hang around and watch the whole video, in other words, because we're going to go through it by the numbers. And we're going to start with the cycle analysis that we've been covering for many years on this channel. Then we're going to go through our classical analysis. Then we're going to go through our Elliott wave analysis. So the market cycle, 4-year bottom to bottom. Right, the next low, if, and this is an if, this is an assumption, if the standard bear market plays out through the winter season period of crypto, and I'm not talking about physical months, I'm talking about breaking the 4-year cycle into 4-year segments, which we call spring, summer, autumn and winter. The winter period will conclude around November 2026. That's as rough as we can get, but as accurate as we can get at the moment, I should say, rather. And we get this by simply taking our prior bull markets, which we're on the monthly time frame here, so let's come down to the weekly time frame and we'll zoom out so we can get a little bit more detail on the chart. So we can see the prior bull markets have been roughly 1064 days in length, give or take a few days, because this is the week chart, not the day chart. So 1064, 1064 and now 1064. And if we move and we bring up our bear markets, right, this was a projection. We will adjust for the actual time when the market seems to have topped. Bear markets are roughly a year long. This was 413, this is 464, 478, and predicting 478 forward again, because we might as well pick one of these and project it forward. We could take 364 if we wanted. This is based purely off of what the last cycle did. This was our projection previous finish line. This has been on the chart for well over a couple of years. in terms of where we suspect we might finish. And as we can see, we finished pretty close to it. So what we're going to do is we're going to come in now, we're going to unlock all of this, and we're going to adjust for where we actually topped. So if we have topped, and it's always if, we are going to move it to here, which is 1050 days. Okay. Once again, this is the week chart, so this is not a super accurate measurement, which brought us in ever so slightly before the prior finish line prediction. We'll leave this here as a historical reference. We will then move the bear market to that high. This lengthens it to 392. I would suggest, given the wave degree we think we're working with, I would like to shrink that at least down. This is all just time analysis. To the 378, it could be 364, and then I will move the bottom projection further forward. In other words, what I'm doing is we topped in October rather than November, December. We will bottom in October rather than a November. I don't know what that is. Rather than a November or December. And then we're just going to move our little arrow across as well, tidy things up a bit. And there you go, guys. So we've adjusted it. We've left that previous finish line in place. And as you can see, if we come down to the day chart for a moment, and we just make sure we're super accurate. Was that the highest recorded price on the day chart? Pretty much. We finished 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 2 weeks, so minus the 4 days, 10 working days prior to the expectation. Right, so it was very close. Not perfect, but it was very close. Okay, so on the cycle analysis idea, if the 4-year cycle holds, we're now in the bear market. And that means we're now in the winter, the crypto winter. And these are roughly a year long. They sometimes start a little earlier, they sometimes start a little later. This one started a little later. This one back here started a little earlier. This one here started a little earlier as well. Sorry, a little later. This is all relative to the top, I should say. So the next thing plays out now. We bottom sometime October, November, December 2026. Could be earlier, could be later. Right. Now, if we bring up our halving analysis for the moment, we can see how this time around the halving did not have the impact that was anticipated. There's been a lot of narratives and reasoning as to why, but the reason we did this analysis was so that we'd have a historical reference going forward in the future. It's all cumulative. So all of this data is essentially what we call multi-confluent factors. We're looking for as many things to point us in the right direction as possible. So we can see that prior to previous halvings, this post-halving move allotted or accounted for 60% roughly of the total price move was post-halving. Right. In prior market cycles, the post-halving move has made up over 90% of the entire bull market. 98.96%, 97.4%, 91.6%, and this one a very disappointing 59%. So it is fundamentally different. It is similar in regards to the majority of the price gain occurred post-halving. That is still true. 60% is the majority after all, but it is a very lackluster move prior to the others. So although people like to use the halving cycle as a timing issue, I personally believe that measuring the 4-year cycle bottom to bottom is proving to be more accurate, as I don't think it's necessarily tied to the halving. I think it's just more likely a timing issue regarding market liquidity across the board and the way things tend to work. I also think it's just the fact that this is what Bitcoin OGs do. They sell after 3 years of a bull market. And you only need to go and look at on-chain data to see that that is true. OG wallets have been moving in a way they've never moved in any prior cycle. There has been big boys unloading before, but not on this scale. So they're just selling. And if they believe it's supposed to be 4 years long and they own most of the Bitcoin, it's probably going to be a 4-year cycle. Okay? Now, we can go around the board and talk about narratives all day. But either way, post-cycle halving move still made up the majority of the move, but it was a very lackluster performance relative to prior cycles. So we can now log that and compare it to the next cycle as and when it begins. And that's our halving data. So we put all of this together and we can see from a market cycle point of view, whether you believe it or not, currently everything is playing out exactly as it has before. We've gone through spring, summer, autumn. We have transitioned into winter. We have gone through a roughly 3-year-long bull market, and we are now transitioning to a year-long bear market. All prior structures took the form of a sharp correction. This was a sharp correction. This was a sharp correction. This was a sharp correction. We are anticipating, if everything plays out, and it's all if, you will understand this later in the video when I talk about the alternative option. If everything plays out as before, this will be a sharp correction as well. We can see that each of the corrections has been significant in drawdown, but they have all been reducing over time. So we had an 86% correction, 84% correction, 77% correction, so far 36% correction. Right? We can expect at least 50, I think. But it could be 60, 70, 80 again, although if the trend, and the one back here was 93%, but it didn't constitute a full cycle, but it was the early days of Bitcoin. But 93%, 86%, 84%, 77%, and now what do we get? 50, 60% maybe? But if this theme continues of diminishing returns post-halving and diminishing bear markets, stabilisation, decreased volatility, likelihood is that it will be less of a drawdown this time. But still a hell of an opportunity. Right, so now that's the price corrections, market cycle. We've covered all of that. So now let's talk classical analysis for a moment, and we're going to start with our exponential moving averages here on the weekly time frame. And for the moment, we're just going to come down to the day time frame because I want to point something out to you. So we're going to start with just the basic moving averages on the daily time frame. We've had the 60 through the 250. Different people use different ones, 50, 200, so on and so forth. I use 50. I use 60 and 250. I've explained multiple reasons as to why I believe this is logical. But either way, 60 through the 250, this is the death cross. This is synonymous with finding a low, not a bottom necessarily. It can signal a bottom, but it often signifies a low. We can see pretty much as this death cross formed, the low was forming just front running it slightly before the death cross occurred. We had the low, we've bounced back up to the 20 daily exponential moving average, and we've started rolling over again. Okay, in historical market performance, if we look at how we've behaved prior to this, once we cross below the 250, we can on occasion come back above it, but when we do it in a bear market, we often come back to test it before falling away from it. So if we look at the breakdown into 2021, we came back up to it, retested it, made another low, then we came through it. This is a liquidity grab. We made a swing high of a higher high and higher low. This would have had people thinking the market was continuing higher. This would have grabbed the bulls, and then we came lower to punish them. So this was the kiss goodbye. So we came through it, came back up to it, kissed it goodbye. As opposed to this one where we came directly through it, back tested it, and moved higher. Prior bear markets, we can see once again in this one from 2017, we came through it, moved above it, grabbed liquidity, down, came up, kissed it goodbye, stayed below it, moved away. If we come to the one prior to that, we can see we did a similar move again. We came through it, back above it to grab liquidity, through it, back above it to kiss it goodbye, and then down to the lows. So once we're below and we've got that death cross, that 60 through the 250, and we sustain the price move below it, we're in a full-on bear market. We've crossed through it now, and this is the first time we've crossed through it this cycle since we've moved above it. So in other words, we came up, we brought the 60 above the 250 back here in March 23 as we came out of the old bear market. We got close to it here, didn't do it. Got close to it here, didn't do it. Got close to it here, didn't do it. Got to it here and did it. So we've crossed the 60 over 250. Not always a sign that we're in the bear market. Okay, we did it here in the bottom of July 21 and then came back above. But what it is a signal of is if it's combined with another important signal, it tends to prove that we're in a bear market. So let me show you what that signal is. Let's come out to the monthly time frame now and bring up our MACD, our RSI, Fear and Greed Index, and our stochastics. So if we now observe the price, what we see is the MACD signal. This is the average crossing through the signal line on the monthly time frame. Two dark red bars in the histogram, growing bearish momentum. Now, in prior bear markets, once this signal of the average crosses through the signal line on the monthly time frame, once this signal is combined with the 60 through the 250 moving averages on the daily, it's confirmation that we're in a bear market. So there is one other occasion which it's occurred, and that was a unique occurrence during COVID when we had the crash down into March 2020. We had the monthly signal of the average through the signal line and the 60 through the 250, but there's two significant differences from other events. The significant differences are: we had a push down into red, then immediate recovery into green. We had a push down into dark red, and an immediate recovery into light red and green. All of the other bear markets started with a push down into red and a continued push down on the next bar. Push down into red, continued push down onto the next bar. If we zoom back, push down into red, continued push down onto the next bar, and so on and so forth, all the way back in time. Right, same patterns played out. And if we were to move forward in time to the current correction, we can see we've had a thrust down into red and a follow through with the next bar. The next significant difference is each time these MACD crossovers have occurred on the monthly time frame, it has been from a new all-time high within the momentum, within the MACD. So this high here is higher than this one, this high here is higher than this one, this high here is higher than this one. The outlier was the COVID incident where it was lower than the prior high, and therefore it was happening during a bull market as opposed to at the top of one into a bear market. Every time we've topped at a higher high, crossed the average through the signal line on the monthly, and had the 60 through the 250 signal, it has heralded a bear market. It has happened after a 3-year bull market, and then we've had a 1-year bear market. Everything from this signal suggests that's what we're doing. So that's now where we are. Now the RSI. So we have our long-term resistance and support lines here. We can see that each cycle the RSI comes down to a lower high. Now we were anticipating during this move to come back to trend. That anticipation, that assumption was incorrect. If we are in a bear market, we have failed to do that. We have fallen short. However, the sequence is still intact. Here's a high, here's a lower 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 high. So that trend's intact and correct and following lower low, lower low, lower low, lower low. Do we come down once again following the same trend to a lower low? Do we come down to the support trend line? Maybe we do, maybe we don't. This goes back to all of the assumptions I was talking about earlier that are going to drive the narrative now. Everyone's going to think they know exactly what's happening all the time. I'm talking to you now as though I know what's going to happen exactly, right? But I'm just explaining what's on the chart. I'm not telling you what I believe. If everything plays out as we've witnessed before, we will have roughly a year-long bear market. We are in one now, and we will have a significant drawdown, and the MACD will play out as before, the RSI will play out as before, and the sharp structure and everything else will play out as before. So that essentially covers everything I want to cover regarding the longer-term classical analysis and cycle analysis. Quick look coming back to the day time frame. We can see we've now entered sustained periods of fear. Okay, that we're seeing build up for a long period of time. Extreme oversold conditions on the RSI here, which of course is bounce. Now, just as we've seen, if we come back to the weekly time frame, when we are in a bear market, historically, we get this sustained period, the winter period, where there is no additional move back above overbought conditions on the RSI. We come down to weekly oversold conditions. So on the weekly time frame, you can see we came down to weekly oversold conditions at bottom of a bullish divergence. During the 2018 bottom, we did have some small divergence right at the bottom, but it really is just a massive oversold signal. We saw during the next bear market 22 deeply oversold conditions on the weekly time frame, and then we saw bullish divergence into the low. We are already at weekly oversold conditions. This is a bit of a novelty. The initial breakdown from prior bull markets came from such an extreme overbought condition that we couldn't get to oversold anywhere near as quick a time. So this one is different. The other thing which is different is the lead on the bearish divergence, which has been building up since March 2024. We've had significant breakdown, series of lower highs on the weekly RSI, so we've been losing strength the whole time into this high, and that's going to feature in our analysis later in the Elliott wave section. So let's now move on to the Elliott wave section. We're going to start with the long-term updated count, making the assumption that we are in a bear market. So You'll be glad to know that the count we've been working with for many years now on the channel hasn't changed one bit. Only the shorter term count has changed. So on the long term, we are still creating 60, 70, 80% drawdowns. They are all sharp structures. So this is an assumption that they are all wave 2s at lower degrees. So we completed super cycle 2, cycle 2, primary 2, and now we're in intermediate 2. And each of these waves is going to be a sharp, a zigzag family structure, and then a significant drawdown of 50% plus. Then we're going to continue higher. And that is the long-term count for the meantime. Now we need to come in to the smaller time frame counts, and this is where things get a little different. Because if you remember earlier, I mentioned that unlike prior cycles where we had let's get the right tool, where we had 1, 2, 3, 4, 5 waves up, 1, 2, 3, 4, 5 waves up. This time we've had 1, 2, 3, 4, 5, 6, 7. This is labelled as a fifth, but it has a different structure to it, and that is what causes some of the confusion and the possibilities which are not likely going to be seen by your standard cycle analysis. So we're going to come into that now. Turn this off. We're going to move over to our index chart. Okay, so now Elliott wave. The Elliott wave section. I've already mentioned the long-term count on the long-term chart based on our cycle analysis. We're going to leave it as it is. Now we're going to come into the count from November 22 into the current high, and we're going to look at two options. Now there are multiple. I've discussed them at length on our group, and the conclusion I would argue collectively, from my own point of view, and I'm not alone, would argue that these are the two most important counts. So let's start with the bear market. We just explained this in detail cycle wise and classical analysis wise. We did have an honest five wave move up, but the last one was an ending diagonal, completing intermediate wave 1, and the market topped at 126,243.80. We are now in a typical sharp structure down into roughly 2026 November October period. Okay, and we are looking for support somewhere between 54,000 and 70,000 as the first port of call. Not a guarantee we'll find support there, but it's our first interest. It's a demand zone, and it also represents highs from the prior cycle. It's a very important zone of support and demand. We can see the bulge here in the volume profile is the most significant one we have until we get all the way down to here. So we're looking for this little node and the valleys within it to provide some support to price to show buyers coming back on board. We will come down in 5 waves, 1, 2, 3, 4, 5 into an A, back in 3, down in 5. On the smaller time frame, the move we've made so far, if I zoom in, and this is open for interpretation, looks to me to be wave 1, wave 2 at minute degree, wave 1 and wave 2, wave 3 and wave 4 at minuet degree, wave 5 at minuet degree into wave 3 at minute, wave 4 into minute, wave 5 into minute, minor A, minor B, minor C is what we'll be expecting to happen. Okay, and this explains the bear market as expected. If we come back through the first invalidation point, minuet 1 at 98872.23, something different is occurring, and I will update you. If we come even higher through 103.604.707, something different still is occurring, and I will update you. I have already updated my patrons as to what this would mean and the possibilities we could have for it with the other counts we've considered, but they would honestly cause more confusion than just talking to you in simple terms about the most likely and most probable outcomes, and that's what I want to keep this to at the moment. So that is the bear market count. Now we're going to move into something which would appear to contradict everything I've said. And if you've only watched the bear market part of the video and you start commenting on my YouTube comment section, oh, Tom's given up and we're in the bear market and he should have said something sooner and so on and so forth, alright, which I have done, my patrons would back me up on this. This part of the video is going to seemingly contradict all of that, and if you miss this part, then you've basically missed the nuance of the whole video. So, I started with 2 statements. One we are likely probabilistically in a bear market. 2, it doesn't have to be the same as prior bear markets. And this is why. I'm going to ask a question rather than make a statement. And this question is, what if we've been in a bear market this whole time? What if the bear market didn't end with the price extreme of period 126? What if it finished with the sentiment extreme? I've been saying that there's no euphoric sentiment at these highs. Some people still want to argue that there wasn't. I've been through 3 of these things now. There was no euphoric sentiment at the highs. Okay, but there was over here in January 2025. We just we elected a Bitcoin crypto friendly US administration. We had the Genius Act on the bill. We had ETFs scooping up the Bitcoin. We had BlackRock. We had all of this stuff going on. We had rumours that the US government was going to buy Bitcoin. We had DATs occurring, digital asset treasuries. It was euphoric in terms of sentiment. What if that's when the market topped? Right? And we've been in a bear market this whole time. We've been in a bear market, guys, if this is true, for 315 days. Which means it's almost over. By the typical standard, it's almost over. Now, we have a very elegant and very descriptive Elliott wave count for this. It's not something let me put it simply, it's not a stretch. It is highly probable. Okay. Why have I left it to this point in the video? Because I've got to be honest with you guys. I've got to go on what the data is saying. Classical analysis, cycle analysis, and Elliott wave analysis can all point to a bear market occurring at this high. But this is the wild card. And the thing it satisfies the most, in my opinion, rather than using an ending diagonal, it explains the move up as a perfect 5-wave impulse into here. Not 7-wave structure, a 5-wave structure. As a single completed impulse. The 6th and 7th waves come as part of a corrective structure. So let's bring that up so I can show you what it is. LTF flat, as it's called. If you don't know my language or Elliott wave and analysis, I call this long time frame. LTF, STF for short time frame. This is the flat pattern. I'm going to zoom out to the day time frame to get rid of some of the detail. We came up in 5. 1, 2, 3, 4, 5. We came down from the January euphoric highs into the A. We came up into the dominant high of the B, which was in October when the market topped, inverted commas, and then came down in a 5-wave of the C, which is still underway, hasn't completed yet. This will be the end of the bear market because it's a year old. It will breach market structure, not guaranteed, it could stop at any moment. Right? The C is allowed to finish before the A, it just probabilistically finishes beyond the A. If it follows its probabilistic path and finishes beyond the A, it will break market structure. What do I mean by that? The trend of higher highs and higher lows and major support at the prior low will be broken. This will be the official bull market dead moment, where we've broken the upward trend of higher highs and higher lows. At the exact moment where sentiment will be on the floor. Everyone will have quit. Everyone will be panicking. Crypto and fear and greed index will be extreme fear. Bitcoin is dead for the 567th time in media history. Okay, and then from here we go to all-time highs. Now, if you just stop as a trader, if you are a trader and you've been trading for decades or less, or even just a few years, and you're like me, this is your third, second, third, fourth rodeo in Bitcoin, right? You're going to be able to appreciate the havoc that this is going to cause. It's going to cause absolute havoc. Okay, amongst traders, amongst crypto bros, amongst the narrative out there on YouTube and on the internet, the analysis, cycle analysis, crypto, it's all going to break down as a result of that happening. Because what's happening now, in the minds of most, and as I presented as a perfectly probable path, is this: A, B, C. That's on everyone's mind. They won't call it A, B, C if they're not an Elliottician, but they can look at prior bear markets and go, oh yeah, it's a year long. comes after 3 years, it's a winter, comes down 50+%, comes down without a new high. So it's 3 waves down. Right? Pretty simple, right? But it's going to be the same level of ignorant, inexperienced people, which we have all been at some point in our lives, who pile in here because they think that's a good price to buy. They come up and then they get bent. Right? But it's going to be people who short and fade the strength off of the low, knowing that we're going to make a lower low. Now let's add it all together and think about the potential chaos this can cause. We break market structure, sentiment hits the floor, everyone gives up. That's the B wave bounce. That's why it's called the B wave bounce. It's a fake rally, a phony rally. It's a suckers rally. And everyone who's been through it before knows it is. And they're going to make the same assumption this time. Right? But they're all wrong. Instead of coming down, we go to new highs. So what happens during this process? The shorts pile in at back test of resistance, the 250-day exponential moving average rolling over that we kissed goodbye that I mentioned earlier. They load up and we do start to come back down because everything moves in waves. We've come up in 5, we come down in 3 or 5, right? So as we come down, the shorts load up even more aggressively. Okay, now they are committed. The next move is this. Now they're trapped and there's no way out because we will never come back below this low ever again. Given the broad account of this into 1 into 2, we can't come back beyond where this wave 1 begins. This is now 1 and 2 again. We can't come back beyond here. The short's trapped. They have to cover. How long they take to cover depends on how early they panic and how much confidence they lose as we head towards new all-time highs. It could be very late in the day that they actually panic, or they could even be liquidated. Okay, if they force to cover because of liquidations, they'll have to buy back everything at a much higher price. Okay. At the same time as this occurs, all of those who are waiting for the lower low and praying for it and hoping it would have a case, myself included, I'm not going to get trapped like this, but I would still be hoping for lower lows because I'm a greedy fucker who wants it cheaper. But at least I know this is a possibility so I can prep for it. They would have missed their chance to get in. So what are they going to do? They're going to do what every retail sucker does. Even if they're intelligent enough to have gone through it before, but this time they've been caught out by a sneaky manoeuvre, they're going to chase. Now we're talking liquidity city. Now this goes into the macro framework, obviously, of lower rates in the future, business cycle recovering, AI saving the planet, ETF inflows being massive, institutionalization expanding, blah blah blah. And then it's liquidity city and we're never coming back. Right? And there's your proper bull market, right? The next phase, the leg 3, the wave 3 up. This is 1 into 2 again, 1 into 2 again. Now we're into the 3 of 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 the 3s back all the way to back all the way to super cycle degree. And there you go. They're the two scenarios. So if I zoom in now and show you this flat pattern in a little bit more detail, we came down in the A off of the sentiment high. We came up between past the 138.2 expansion target for the B, but we did not invalidate at 1618, which would be 138,000. We came in below that. Right. We then started our progression down in the C. 1 into 2, 3 into 4. Might be done here at a larger wave degree, but I've got it as a smaller wave degree. But that might be 3 into 4 here. Then we come down into 5. We get our target zone between the bottom of the wave A and the 1618 extension for the C, which is the length of the A projected from the B. 161.8% the length of the A. This is an expanded flat. 3 down, 3 back, 5. 3, 3, 5. Flat pattern. Messes with everyone's heads. Comes down, it clears the low, breaks market structure, convinces everyone on the planet that it's super bearish, and then goes to new all-time highs. Not a B-wave bounce, which will be the anticipation of more experienced traders who know it's coming, because just when retail give up completely and think it will just fall through the floor, that's when it bounces. But those of us who've been doing this for a few years will know that's the B-wave bounce, but this time it isn't. It's not B into C and lower, it's 1 into 2 and higher. And that's going to fuck everyone who isn't thinking about this. So the way I'm preparing for this, since I'm greedy and I'm willing to wait and back the primary idea that it will come lower, it doesn't matter to me if I accumulate at the long term here, because we're going to an all-time highs off of that scenario anyway. So I'm going to buy whatever long-term accumulation I want to purchase near the lows or 50% plus drawdown at my expected target, I'm going to put half of it on the table here. And if I see these invalidation levels, as I mentioned earlier, for our various counts that we have alternative to this, if we were to bottom early and start climbing out of here in 5, I'm going to commit on any pullback. But if we breach through here, A, B, C flat, I'm putting 50% of what I was going to put on a full bear market here, and I'll sit on my hands for 10 years, 5 years, 10 years, whatever. But I'm going to trade this because this is a B wave at least. If it's not a B, then it's often all-time high. So I'm going to take on trades, paper trades. Here, I'm going to manage the risk from whatever low we form, and I'm going to use that as my stop. And it could be a double win. 50% allocation long-term hold, right, and the rest allocated paper trading, and it could turn into a long-term hold for an entire bull market. If it rolls over, I get stopped out. I add the other 50% in as and when we break down to lower targets. Right. But if I just sit on my hands the whole time and do nothing, assuming we're in a year-long bear market, and I said I'm going to wait till November next year, I could miss this thing. Right. And if I jump the gun early and throw 100% at the lows like a lot of rookies are going to do, I could get crushed by another 50% drop or more. So I'm going to weigh things up, and I'm going to manage risk long and short, and both time frames, and I think that's how I'm going to approach it. Now you can do whatever the hell you want to do, that's up to you. I'm not going to tell you how to do things, that's up to you, but that's how I'm going to manage it, because I've got a very long-term view. So I'm going to take the luxury of long-term allocation, and I'm going to take the luxury of short-term trading, and I'm going to use both based on this analysis. So I'm going to leave that there. Bear market explains itself. We completed an ending diagonal, we're working on an ABC down. The thing that no one's probably seen is the idea of this flat, and this could cause a lot of damage, psychologically as well as anything else, because it breaks everything. It breaks everything. If this was true, it wasn't a 4-year cycle. If this was true, the bear market didn't begin in October, began in January. If this is true, it's not going to bottom in November 26, it's going to bottom this year, or January, February next year, early. And it's just going to catch a lot of people out. So that explains the Elliott wave. As I mentioned, if we start to rally from here, because the 123.6 extension target here and the 131.8, which we touched perfectly, which is an algo target for the C wave, we've bounced from. So this could be it here. More likely we break market structure and create that trap, that liquidity trap, because that will hurt more people, and markets tend to try and hurt as many people as possible. But if we can, if we were to suddenly start climbing out of here in 5, and we breach invalidation points here and here, and then we come back in 3, this is the equivalent bottom, what we call the STS standard trade setup. Because this is either the B wave, 3 wave move, and this is the first pullback, or this is 1 and 2, and we're off to new all-time highs. But you see why I don't want to include half a dozen other counts, because it'll just confuse the fuck out of everyone. Right, and I'm not going to do that. So we're working on this, and we're working on the idea that the market's topped. And that's it. So super fast summary now. In case you haven't watched any of the video, you're like, I'll just go skip to the very end where it says summary. Fair enough, I don't blame you. I don't want to hear in the comment section though how Tom's guaranteed we're in a bear market, or Tom's guaranteed it's this flat. I've tried to cover everything, I've tried to be reasonable. I've said probabilistically, from a cycle point of view, from a classical analysis point of view, we're in a bear market. If this bear market plays out as all the other prior bear markets have played out, it'll be a year long and it'll be a sharp zigzag down 50% plus sell-off. It'll break market structure, there'll be a B wave bounce, everybody will try to accumulate, and anyone who's inexperienced will get chewed up. Alright? But there's the outlying possibility that it's a flat and we've been in the bear market for a year long and we're already close to finishing and we're about to go new all-time highs after breaking market structure and fuck everyone over. So let's sum it up. Bear market. We've finished 1, 2, 3, 4, 5. Fifth was an ending diagonal. Market topped at 126, 243. Right on schedule given our time analysis. Right on schedule given us the seasonal analysis. And then we're down, looking for 5 waves down in a B wave bounce into the middle of next year or maybe late spring, and then a C wave down into the end of next year to complete the bear market around October through to December 2026. Zigzag, sharp, same as all the others, la-di-da. The alternative is long-term flat pattern. The market peaked in January 2025, not October. It's already 315 days through a bear market. There's not much of it left. We're likely looking to breach market structure at the lows when the C crosses beyond the A wave, and then we move to new all-time highs, and no one will be expecting it because the bear market's already come and gone. Right. This is the surprise package, and it's not a reach regarding the analysis. It's perfectly reasonable from an Elliott Wave point of view. It will screw a lot of people over, it will cause a lot of confusion, but it should be in the back of the mind of everybody who's aware of Elliott Wave and can think that this could happen, because at least now we can prepare for it. If you missed that bit, I explain how I would prepare for it. Okay, so flat patterns, the wild card. We've been in the bear market the whole time. There's a lot of narratives to support this as well, though, right? I pointed all the classical analysis and macro analysis which support typical bear market, time cycles, all that. This one's supported as well by macro ideas. Where was the alt season? Never happened, right? Why didn't it happen? Because Bitcoin never topped at 126, right? Where's the euphoria at the high? There wasn't any. Where's the price blow off? Where's the post-halving gains? All this stuff. This is all explained by this structure occurring, right? So it's got evidence to support it. It's not just technical. You can make any number of points you want to make to support it, right? So that's it, guys. I'm going to leave you there. There are other things to consider. Please don't come back at me with a dozen count suggestions in the comments, because I'm not going to read them. We've considered best part of a dozen already. Probably half a dozen, seriously, in our group. And I posted them to the Discord, the ones that I feel most probable. But these are the two main ones. We've either topped in a bear market, right, and we're coming down in a zigzag, standard operating procedure over a year, buy Bitcoin when it's at a sell-off, when it sells off, or we're in this flat and it's going to catch everyone out. Right, both have to be on your radar, I feel, and I would like to leave it there, guys. Okay then, so if you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And if you want to learn Elliott Wave and you want to learn some classical analysis techniques, and you want to learn some trading techniques, then feel free to sign up to my Patreon. There's a link in the description box below. We've got a public Discord where there's lots of valuable members always posting lots of interesting ideas. We've got an educational series on trading as well as on Elliott Wave. I do weekly updates, video updates for Bitcoin, gold and the SPY every week for my members. I do additional series of videos covering asset requests from our members. You can request for me to look at any asset. It's a bit of a backlog. It takes me time to get through it, but I eventually do get through it. And also, if you join up at tier 3, you get a stock rating system, dividend calendar on a monthly basis, and you also get some further analysis called Watch List, where I look at individual stocks that I find particularly interesting at the moment. So all of that's available. It's only 10 quid a month. You can leave it any time. And yeah, there you go, guys. Like I said, feel free to sign up if you want to. And until I see you again, take care of yourselves. Keep yourself calm in what will be a sea of worry and concern and panic around the corner if things play out as predicted, and try to rise above it all. Don't fall for the narrative. Don't get caught up in the noise. Keep your head clear. Keep your powder dry. Keep your stops close. Avoid leverage. Avoid margin. And primarily avoid stupidity. And this will be another great opportunity. Take care of yourselves. See you soon. Bye bye.